Hello, I'm Danielle Zayer, a Senior Project Manager with the Financial Accounting Standards Board, or FASB. In this video, we will walk you through an example of how a lessee might apply the new leases standard using the display approach. With me today to help explain is FASB Assistant Project Manager Lisa Kessel.
Glad to be here. Thanks.
In our video, Lessees Putting It on the Balance Sheet, we mentioned a method called the display approach that a lessee can use to place its operating lease obligations on the balance sheet. Lisa, would you mind starting off with walking us through this example?
Certainly. Let's start with Smallco, an organization with several operating leases. Smallco has a 10-year lease of office space with lease payments that start at $1,000 in year one. They increase by 5% each year, are paid annually in arrears, and a discount rate of 6%. They also have a 15-year lease of plant and warehouse with lease payments that start at $1,200 in year one, increase by 3% each year, are paid annually in arrears, and a discount rate of 7%. They have a 4-year lease of a forklift with fixed lease payments of $250 and paid annually in arrears, and a discount rate of 6%. A 4-year lease of a salesman car with fixed lease payments of $150 paid annually in arrears, and a discount rate of 5%. And lastly, a 3-year lease of an office copier with fixed payments of $100 paid annually in advance, and a discount rate of 5%.
Smallco has the following schedule which tracks each of those leases. For simplicity purposes, we are assuming that the commencement date for all 6 leases is 1/1/20X1. However, note that not all periods are presented in this table. In the table, you can see each of Smallco's operating leases. This is the same operating lease tracking schedule that would be used to compile the information for the disclosures under current GAAP, that is, under Topic 840. The only changes made to this schedule are to maintain the commencement date discount rate, the calculation of the total lease liability at the reporting date, and the current portion of the lease liability at the reporting date.
As I'm sure you've noticed, the commencement date discount rates aren't the same for each of Smallco's operating leases. This is because the discount rates used are either the implicit rate in each lease, or if that is not readily determinable, the incremental borrowing rate for an equal amount of borrowings over a similar term in a similar economic environment. Therefore, these rates typically will not be the same, especially if the leases have different commencement dates in different terms. Before we continue, we would like to also explain how we calculated the total lease liability at the reporting date and the current portion of the lease liability at the reporting date. For purposes of this example, the reporting date is 12/31/20X2. The lease liability for each lease equals the net present value of the remaining lease payments. This is calculated by using the Excel net present value or discount function, using the remaining cash flows and the applicable discount rate as inputs.
For example, the first lease for office space is for 10 years. The table shows the initial payment in year 1 of $1,000, the 5% increase to $1,050 in year 2, the 5% increase to $1,103 in year 3, etc. At the 12/31/X2 reporting date, you would total the remaining lease payments, that is, for years 20X3 through 2X10, the total of those remaining payments and the discount rate of 6% input into the Excel discount function results in a lease liability for the lease of office space as of 12/31/X2 of $8,051.14.
To determine each current portion of the lease liability, we have also used the net present value function. However, it only considers the payments that will be made within the next fiscal period, as opposed to all the remaining payments. In this example, the current portion of the lease liability is the present value of the lease payments that will be made in 20X3. So for the lease of office space, the present value of the $1,103 of lease payments to be made in 20X3, discounted at 6%, is $1,040.09. Once you have determined the lease liability and the current portion of the lease liability for each lease, you can add the leases together to arrive at the total lease liabilities at the reporting date in the current portion of those lease liabilities.
For this example, the following hypothetical general ledger was created for Smallco. As of 12/31/X2, Smallco had $100 remaining in prepaid rent, which is a result of Smallco prepaying its rent for the copier machine each year. Smallco also had $150 in the current portion of deferred initial direct costs and $850 in the long-term portion of initial direct costs. The current portion represents the initial direct costs that will be recognized within the next fiscal period, and the long-term portion represents the remainder of those deferred costs. Smallco accrued $1,005 in rent during the period due to its office space and plant and warehouse leases. For accounting purposes, the expense of these leases is straight-lined, but the lease payments Smallco has been making per the lease contract represent amount less than the straight-lined expense. Therefore, Smallco has been accruing rent throughout the life of these leases. Per company policy, Smallco allocated $1,358 of its lease expense to general and administrative. That is for the lease of the office space and the office copier, $150 to sales and marketing for the salesman car lease, and $1,938 to cost of goods sold for the plant and warehouse, forklift, and delivery truck leases. This is how Smallco's general ledger would appear under current GAAP. The new guidance would not require the process to change.
At the reporting date of 12/31/X2, Smallco would record the display approach journal entry, topside, to present the balance sheet in accordance with the guidance in the ASU. The current and the long-term portions of the lease liability taken from the tracking schedule are credited, and prepaid rent and the deferred initial direct costs and accrued rent are reversed. The balancing debit represents the right-of-use asset. After making this topside journal entry, Smallco's balance sheet would present the following in accordance with the guidance in the ASU.
It is important to note that companies are permitted, but not required, to present operating lease assets, current operating lease obligations, and long-term operating lease obligations separately. In the above balance sheet, these accounts are presented separately for illustrative purposes.
On 1/1/X3, a reversal entry would be recorded to back out the year-end topside entry and allow Smallco to continue using its current systems and operating lease tracking schedule.
We hope that this short example has been helpful. In closing, I'd like to remind everyone watching that the FASB has a technical inquiry service for any questions related to the new leases standard. You can fill out a technical inquiry form located on our website, www.fasb.org. Thank you for tuning in.